Right now, thousands of Canadian families are walking blindly into a financial slaughterhouse, completely unaware that the government is about to confiscate a massive portion of their inheritance. You might think you are safe because the highly publicized capital gains tax hike was recently canceled, but that political distraction is exactly what is blinding you to the real traps waiting in 2026. Imagine your parents spending their entire lives building a legacy for you, a family home, a retirement portfolio, a small business, only for the Canada Revenue Agency to freeze those assets and demand hundreds of thousands of dollars in taxes before you receive a single dime. This is the brutal reality of the Canadian tax code right now, but if you take action today, you can absolutely legally protect your family's wealth. Welcome back to the channel. I need you to pay very close attention because the rules of the game have shifted dramatically over the past year. Subscribe to Tax Hack Pro right now, because this is where we cut through the political noise and break down the complex financial strategies that actually protect your money in plain, simple language. Today, we are tearing apart the most searched, the most misunderstood, and the most financially devastating topic in Canadian personal finance: estate taxes, inheritances, and the massive tax bombs waiting for your family in 2026. First, we need to correct a massive misconception that is spreading like wildfire across the country regarding the capital gains inclusion rate. Over the last couple of years, the federal government sent absolute shockwaves through the middle class by proposing an aggressive increase to the capital gains inclusion rate. They wanted to raise the taxable portion of your capital gains from 50% to a punishing 66.67% for gains over $250,000, with an effective date slated for January 2026. This caused absolute panic. Families were scrambling to sell assets and reorganize corporations. But then the political landscape completely fractured. Justin Trudeau stepped down, Parliament was prorogued, and in early 2025, Prime Minister Mark Carney officially canceled the proposed inclusion rate increase. The rate is staying at 50%. Because of that cancellation, a highly dangerous false sense of security has washed over Canadian families. People are exhaling, putting away their financial documents, and thinking their estate is completely safe. But this assumption is costing families dearly, and here is why. Even at a 50% inclusion rate, the underlying mechanism of how Canada taxes you at death remains one of the most aggressive wealth extraction systems in the Western world. People mistakenly believe that Canada does not have an inheritance tax. While it is technically true that there is no formal inheritance tax bill mailed directly to the beneficiary like they do in the United States, Canada absolutely taxes estates. They just use a much stealthier, much more destructive weapon called deemed disposition. Let us break down exactly what deemed disposition means, because this is the primary mechanism that will gut your family's wealth if you do not prepare for it right now. When a Canadian resident passes away, the Canada Revenue Agency treats that person as if they sold every single asset they owned at fair market value exactly 1 minute before they died. There is no actual sale, no money changing hands, no real estate agent involved. But the CRA taxes the estate as if a massive multi-million-dollar cash transaction just occurred. Let us look at a real-world example to see how terrifying the math actually is. Suppose your parents bought a family cottage in the Muskoka region or a cabin in British Columbia 30 years ago for $80,000. Over the decades, the real estate market exploded, and that secondary property is now reasonably worth $1 million. Under the deemed disposition rules, when the last surviving parent passes away, the CRA says, "Congratulations, you just realized a $920,000 capital gain." At the current 50% inclusion rate, $460,000 is immediately added to your parents' final income tax return. Depending on their specific province, that could result in an immediate tax bill of well over $230,000. And that massive tax bill is due immediately to the government. The CRA absolutely does not care if the estate has the liquid cash in a bank account to actually pay it. If your parents' wealth is entirely tied up in the physical property, the estate will be legally forced to sell the beloved family cottage just to pay the taxman. The asset they worked so hard to keep in the family is gone forever, auctioned off to a stranger to cover a phantom tax liability. You might be sitting there watching this and thinking this scenario only applies to the ultra-wealthy. That is the second biggest mistake you can make. The reality in Canada in 2026 is that ordinary, hardworking middle-class families are sitting on assets that would have seemed unimaginably valuable a generation ago, purely because of the unprecedented, historic inflation in the real estate market. A teacher and a nurse who bought a second property as a rental investment in the 1990s for $200,000 might now have a real estate portfolio worth over $2 million. While your primary, everyday residence is generally protected from capital gains taxes by the principal residence exemption, every single secondary property, every rental unit, every commercial space, and every non-registered stock portfolio is fully exposed to the deemed disposition hammer. But the absolute deadliest tax trap waiting for Canadians in 2026 has nothing to do with real estate at all. It is the Registered Retirement Savings Plan, the RRSP, and the Registered Retirement Income Fund, the RRIF. I need every single adult child and every parent watching this to hear this section clearly. If a parent passes away with a large RRSP or RRIF and they do not have a surviving spouse to roll it over to, the entire absolute balance of that account is instantly added to their income in the year of death. Not a percentage of it, not just the capital gains on it. Every single dollar inside that account becomes fully taxable income overnight. If your father spent 40 years diligently saving and dies with $500,000 in his RRSP, the CRA adds $500,000 to his final tax return. This instantly catapults him into the absolute highest possible marginal tax bracket. In provinces like Ontario, British Columbia, or Nova Scotia, the government is going to forcefully take over 50% of that money. That is a $250,000 tax bill generated overnight by a retirement account. That money has to come from somewhere, and it almost always comes directly out of the inheritance meant for the children or grandchildren. The federal government essentially becomes an equal 50% partner in your parents' life savings the moment they pass away. Now, you might be relying on the spousal rollover to protect you. When assets are passed to a surviving spouse or common law partner, the deemed disposition at death can be legally deferred. The tax does not come due right away. It patiently waits until the surviving spouse passes away or sells the asset. This is an incredibly powerful tax planning tool, but here is the fatal flaw in how most families view it. They incorrectly assume the tax problem just goes away. It does not go away. It is simply postponed and allowed to grow much, much larger. When the second spouse eventually passes, the full, compounded, accumulated gain on all of those assets from the original purchase date hits the estate all at once in a massive wave. Without aggressive forward planning, the final estate of the surviving spouse will face an astronomical tax bill that can entirely wipe out the generational wealth transfer you thought was secure. Before we get into the exact, step-by-step strategies you need to use to fix this, we have to bust the most dangerous, toxic myth circulating on social media right now. So many people think they can outsmart the CRA by simply adding their adult children to the title of their home or their investment accounts while they are still alive. They think this joint tenancy hack will bypass the estate and avoid all the taxes. Do not do this under any circumstances without professional legal advice. Adding an adult child to the title of your property is considered by the CRA to be a deemed disposition of a portion of that property. You could trigger a massive, immediate capital gains tax bill today while you are still alive. Furthermore, the absolute second you put your child's name on your asset, your hard-earned property is now fully exposed to your child's creditors. If your child gets sued, goes bankrupt, or goes through a nasty divorce, your house is now considered part of their severable assets. The ex-spouse or the bankruptcy trustee can literally force the sale of your home. Trying to save a few dollars on future probate fees could literally cost you the roof over your head today. If you're finding this financial breakdown valuable and you want to stay 3 steps ahead of the CRA, make sure you subscribe to Tax Hack Pro. We are dedicated to giving you the exact, forensic blueprints to navigate the Canadian tax system, keep your hard-earned wealth inside your family tree, and permanently stop overpaying the government. So how do we actually fix this? How do we build a fortress around your family's inheritance in 2026? The first and often most cost-effective strategy is utilizing permanent life insurance. Life insurance is arguably the most underused and deeply misunderstood estate planning tool in the entire country. You do not buy permanent life insurance to get rich. You buy it to provide instant, tax-free liquid cash to your estate exactly when the CRA hands your executor the tax bill. If you know mathematically that your family cottage is going to trigger a $300,000 capital gains tax upon your death, a properly structured life insurance policy will deliver that exact amount of tax-free cash directly to your beneficiaries. This allows your children to hand the cash to the CRA and keep the cottage safely in the family, entirely debt-free, without having to take out a high-interest mortgage just to pay the tax. The second highly effective strategy is the estate freeze. This is absolutely critical for small business owners and families with significant real estate portfolios. An estate freeze is a brilliant corporate strategy where you legally lock in the current value of your assets today. You exchange your growing corporate shares for fixed value preferred shares, and you issue brand new common shares to your children or to a highly regulated family trust. What this fundamentally does is freeze your eventual death tax liability at today's exact value. All the future growth, all the future appreciation of the company or the real estate over the next 20 years accrues directly to the next generation. Your estate is only taxed on the frozen value, potentially saving your family millions of dollars in future capital gains taxes that would have otherwise compounded. Speaking of small businesses, we have to talk about the lifetime capital gains exemption. While the government canceled the inclusion rate hike, they kept the massive, historic increase to the lifetime capital gains exemption, bumping it up to a staggering $1.25 million. This is incredible news for Canadian entrepreneurs, but qualifying for this exemption is incredibly strict and heavily audited. The CRA requires your business to meet specific, rigorous asset and holding period tests. If your corporation has too much passive cash, real estate, or non-active investments sitting inside it when you pass away or sell, you could lose this $1.25 million tax-free exemption entirely. You must engage in a complex accounting process called purification of your corporation years before an actual sale or deemed disposition ever occurs. The third vital strategy is addressing the catastrophic RRSP tax bomb through a strategic, calculated meltdown. If you're entering your retirement years and you have a massive RRSP, you absolutely should not be leaving it all to compound until you die. You need to work closely with a fiduciary financial planner to start gradually drawing down that RRSP or RRAF during your lower-income retirement years. You take the money out strategically, pay the tax at a much lower marginal rate today, and aggressively reinvest the after-tax proceeds into a tax-free savings account, a TFSA, or a permanent life insurance policy. A TFSA passes to your beneficiaries completely tax-free, without triggering any deemed disposition penalties. By melting down the RRSP slowly over a decade, you meticulously diffuse the massive tax bomb that would otherwise obliterate the account in the year of death. Fourth, we must look at testamentary trusts and qualifying spousal trusts. A will is not just a simple piece of paper that says who gets the silver and who gets the house. It is a foundational, highly powerful tax document. By embedding specific trust structures directly inside your will, you can exert immense control over how and when your assets are distributed. This protects your beneficiaries from their own bad financial habits, their greedy creditors, or highly destructive future divorces. Elite estate planning lawyers use these specific trusts to legally split income and significantly reduce the overall tax burden on the surviving family members for generations to come. There is another massive trap that catches wealthy Canadian families completely off guard in 2026, and that is the United States estate tax. If your parents own a winter condo in Florida, a vacation home in Arizona, or even just a large portfolio of American stocks in a non-registered account, they hold what the IRS calls U.S. situs assets. While the Canada-U.S. tax treaty provides certain exemptions based on your worldwide net worth, the rules are incredibly complex. If your estate crosses the thresholds, the U.S. government can legally seize up to 40% of the value of those American assets upon your parents' death. You could find yourself fighting a grueling financial war against both the Canada Revenue Agency and the Internal Revenue Service at the exact same time. Information without aggressive implementation is completely useless. It just creates financial anxiety. Here are the exact, non-negotiable action steps every single Canadian family must take heading into the rest of 2026. Step 1. You need to conduct a comprehensive, brutally honest estate inventory. Sit down at the kitchen table this weekend and list every single asset: the primary home, the cottage, the rental properties, the business shares, the RRSPs, the RRIFs, and the TFSAs. Write down exactly what you originally paid for them and what they are reasonably worth in today's inflated market. This will give you a terrifying but absolutely necessary baseline of your true capital gains exposure. Step 2. You must immediately review and legally update your will. If your will is more than 5 years old, it is functionally obsolete in the current tax environment. An outdated will, or worse, dying intestate without a will entirely, practically guarantees that your assets will be distributed according to rigid provincial formulas. This triggers maximum taxation, maximum delay, and maximum probate fees. Step 3. Aggressively review every single beneficiary designation on your registered accounts and your life insurance policies. These direct designations completely override your written will. If your RRSP still lists an ex-spouse or a deceased parent from 20 years ago, the financial institution will hand the money directly to them or their estate, completely bypassing your current family. This administrative disaster happens every single day in Canada, and it permanently destroys families. Step 4. Calculate your total exposure to provincial probate fees. Probate is the mandatory legal process where the provincial court validates your will, and they charge a very hefty fee for the privilege of doing so. In Ontario, the estate administration tax takes roughly 1.5% of the total value of your probatable assets. On a modest $2 million estate, that is $30,000 right off the top, entirely separate from the CRA's income taxes. You can legally minimize probate by holding certain assets in joint tenancy with a spouse, perfectly utilizing beneficiary designations, or creating secondary restricted wills for private corporate shares, but you must execute these legal strategies precisely. Finally, the most important and urgent step you can take today is to have an uncomfortable but necessary conversation with your family. The families who successfully navigate the brutal Canadian tax system and preserve their generational wealth are not always the wealthiest families. They are simply the most prepared. Surprises after death are always catastrophically expensive, both financially and emotionally. Your children need to know exactly where the documents are, who the accountant is, and what the incoming tax liabilities will be. If this video opened your eyes to the severe financial realities facing your family, you absolutely cannot afford to sit on this information. Share this video with your parents, your spouse, or your adult children right now before you close this app. The absolute highest cost in Canadian estate planning is always the cost of waiting until it is mathematically too late to fix the problem. Hit the like button to help this critical financial education reach more Canadians who desperately need it, and make sure you subscribe to Tax Hack Pro so you never miss our forensic deep dives into wealth preservation, legal tax loopholes, and elite financial strategy. The government is always going to aggressively collect what they believe they are owed. Your job, and the entire purpose of this channel, is to ensure that number is legally as small as possible, and that the wealth your family sacrificed their lives to build ends up exactly where it belongs. I will see you in the next video.